The buy the dip strategy has tended to be a good one for the better part of the last 10 years. The big exception, of course, being fourth quarter of 2018, when the market basically got swallowed up to the tune of about 20%. But the rationale behind the buy the dip mentality is when the Fed is at your back, when the Fed is in a market-friendly posture, as it wasn't in the fourth quarter of last year and it's perceived to be is market-friendly again in the first quarter of this year. When the Fed is market-friendly, the feeling is that traders should be buying every dip because eventually there's money coming in. The Fed has got your back, and they won't let the market fall too far. So every dip is a trading opportunity. That's one of those strategies that works until it doesn't. And the problem is for a lot of investors, it works really well until it doesn't. And it's worked essentially from Christmas on. More or less every dip has proven to be a buying opportunity. We've been in a steadily ratcheting higher market. We've seen the S&P futures essentially just riding the 10-day moving average. Occasionally it will dip below the 10-day moving average and find some support at the 30-day moving average. So you could argue that even then, if you bought a dip, it really wasn't too tragic. It eventually turned itself higher. And I think that explains a lot of the market activity that we saw Monday and Tuesday. To recap a little bit, when we came in Monday morning, the news over the weekend was that the president wanted to reinstate 25% tariffs on Chinese goods effective the end of the week. Markets freaked out, which is not necessarily an unrealistic reaction to something of that nature. And we saw the S&P futures down 40 or 50 points when we came in the morning. The selling beyond that level never really materialized, and that was more or less right around the 30-day moving average of the S&P. And so the market sort of found its legs and started drifting higher throughout the day. And that drift higher picked up momentum, emboldening people to perceive this as yet another solid opportunity to buy the dip. And considering that at the lows, we were down about 9 or 10 points on the S&Ps, someone really could have had an opportunity to make 1.5% on the S&Ps or more in individual stocks within a given day. That ratifies the buy the dip mentality, doesn't it? Until Tuesday comes around. And after the close Monday, it was clear that they were not joking about the tariffs. These were not necessarily strictly a negotiating ploy, but something that may actually put a wedge into the trade talks. And we saw the S&Ps open down between 15 and 20 points. The problem for the buy the dippers is we continued to sell off throughout the morning, falling well over 40, almost 50 points later that day. So the problem is buy the dip works until it doesn't. And it's not necessarily there's nobody waving a flag telling you when buy the dip doesn't work. The other thing to keep in mind is if you're doing this because of the Fed providing some sort of backstop to the market, even when they're very market friendly, they're not backstopping every 2% move, every 1% move. It seems to me that they're going to be more concerned about backstopping, let's say, a 5 or 10% downtick. We certainly want to prevent something even bigger, and we'll do their best to help the market out. But in the short term, these intraday moves, where when you look back on a chart and see that the events of the past few days, when you go back, let's say back to the Fed meeting last Wednesday, where we sold off, but only down to the 10-day moving average, and then fell a little bit below it on Thursday, and then rallied higher again on Friday after the employment numbers. This is all, when you step back and look at a longer-term chart, this is all normal market activity. So be careful about buy the dips. If you feel that the market is wrong for some particular reason, that's when you take your shot. If you feel the market's lower just because it's lower and it's going to bounce back, that's not a really good rationale. Use your judgment here because the Fed may be your friend, but it's not necessarily your best buddy all the time.